Welcome back, everyone, to the Exchange Live. My name is Paul Hill, and I'm delighted again to be able to speak to accomplished UK fund manager Adam Rackley of Dowgate, Cape Wrath. So welcome, Adam.
Hi, Paul. Thanks for having me back.
Well, yeah, we could really sort of pick your brains here. We've got lots of sort of like cross currents on the market. On the positive side, we have sort of falling inflation. Expectations for interest rates are also coming down. Rising real incomes for most people. Plus, in the UK, low equity valuations or historically low equity valuations. But equally, on the other, we've got the ongoing wars in the Middle East and Ukraine. Plus, we have that sort of like in 2 weeks' time, we got the budget and the US presidential election. And we actually had quite a few profit warnings of late in sort of small cap land. But we've always sort of like run through your outlook for the market. So I don't suppose you could just quickly remind the audience what kind of investor you are, what kind of stocks you like.
Sure. So I run a UK deep value strategy with a small cap bias. So we are, I guess, if you look at a kind of, like a style box, we're kind of down in the kind of bottom left-hand corner, kind of deep value small cap focus, which is a niche corner of the market. Not a lot of people fishing in that corner. And then within that, we've got what we call a behavioral value strategy. So we're really looking for situations where other investors are selling for what we feel are emotional rather than rational reasons. And so the types of companies that we're interested in might have had 60, 70, 80% share price declines from recent highs. And we call those capitulation events. So we are looking for capitulation events as ideal entry points, and then an opportunity for a narrative shift to drive a re-rating on the way out. And I mean, it's quite a contrarian strategy, and I guess the key thing with our strategy is really to be on the lookout for value traps. So that is the kind of key risk with a deep value approach like this, because it's all very well being contrarian, but 90% of the time, 80% of the time, the market's right. So if you make a point of trying to always do the opposite, you're going to get poor very quickly. So a lot of what we do is try and make sure that we take our moments to bet against the market.
Yeah. Well, you must be quite interested or busy at the moment then in that case, because with the sort of the impending budget, we've had quite a few capitulations events and the small cap sector has been totally hammered. In fact, I looked at a stat, and if you look at it over the last 10 years, AIM has gone absolutely nowhere, a lost decade. So what's your sort of like your view for small caps going forward? Because we seem to be at really quite extreme levels for a lot of AIM stocks in particular.
Yeah, I think that, I mean, as you point out, valuations are really at trough levels in terms of kind of within the UK market, smaller versus larger, in terms of the UK market versus global peers. So I think low valuations is always a great point to start at. I think for our style of investing specifically, because it's got a small cap bias, because it's deep value, we are kind of a kind of risk on strategy, as it were. I mean, a lot of what we try and do is focus on stock specific risks, but in periods when there's a kind of more risk aversion in the market, flight to quality, those are harder times for us. And then at points when the risk appetite comes back, that's when we really do well. And so, I think things like, as you pointed out, a lower inflation print and the prospect of perhaps interest rate cuts coming in, an end to that kind of that drift out of the expectation of interest rate cuts is certainly going to be helpful and improve risk appetites, I think. And also, for some of our stocks specifically, improved availability to debt financing, for them or for their customers, is also going to be helpful. We can touch on that.
Yeah. And what about you mentioned avoiding value traps? No, I have this problem all the time. I fall into them because I'm sort of quite contrarian bias as well. But how do you sort of like identify a value trap, regardless compared to say a value play, before you go into it?
Yeah, so we've got, I mean, I guess most of our process is all around trying to calculate, is looking at risk and trying to work out what an appropriate entry point is to give us the best risk return payoff. I mean, two key things really to look out for are structural issues, so structural decline and too much debt. Those are two key areas, and both taken in combination can be a pretty explosive setup. So we look at those up front, and what we want to try and do, because when we get into the deep dive part of our process, it's very involved. So I work very closely with my colleague Anders, and we get into a deep dive, and it's probably a week of his time, a week of my time. So it's a lot of man hours goes into that deep dive part of the process. So we want to try and weed out as much as possible before we get to that point, because you get into that point and there is the opportunity cost. If you look at a company that turns out it was never going to be a good investment, there's the risk of kind of, from a behavioral perspective, commitment bias. You spend all this time looking at a stock, you think, oh, I really want to invest in it now. I've spent all this time on it. So a lot of what we do is try and front end load, and elements like structural decline and balance sheet risk are two key areas to consider.
Yeah. I find my biggest problem is I start off with a value play, but unfortunately then you haven't got a crystal ball, and then it becomes a value trap afterwards because it has a big problem which sends it from net cash to net debt or something crazy like that. Now, a feature of your fund seems to be that you own quite a few of the big chunk of the shares in the fund. Is that correct? I looked at it and you own about 8% of the stock.
Yeah, that's right. Yeah, that's right.
So
I mean, as the fund
eat
has
your own
grown,
cooking.
absolutely 100%. Yeah, I mean, my investable net worth, is in the fund. And when the fund launched, I was a lot. I was well over 50% of the fund, and we've grown some assets, and so my stake's been diluted down. But for me, my key interest is as an investor, and the fund is a vehicle for me to invest my own money. And if we can get other people along for the journey, then so much the better. But it's primarily about investing the way that I feel is the right way to invest, and the way that I invest my own money. So I don't have a kind of a fund and a PA. The fund is my PA effectively.
No, I think that's a real positive. That's really definitely putting your money where your mouth is. So well done for that. Now, if anybody wants to ask Adam any questions, please put them into the chat bot and I'll read them out. We've got a first one coming from Stephen Mackey. He's asking about what your latest thoughts on Alliance Pharma, which is an over-the-counter healthcare products business that has done through a bunch of acquisitions and buy and build strategy. I think it's got about sort of 3/4 of it's into over-the-counter products, and then another third or quarter is in prescriptions. Makes good margins, etc. And it's on a sort of a growth track. What's sort of your latest for this one? Because it's paying down a bit of debt, I think, at the moment.
Yeah, that's right. I mean, as you said, there's two elements of the business. So the kind of consumer over the counter is higher margin, higher growth, brand based. The prescription business is kind of stable, cash generative, lower growth segment. This business has had a few, as all the businesses that we like to look at, it's had a few issues in the past. So there was a investigation by the Competition and Markets Authority in 2022, and they were originally charged with price fixing, effectively. So they had a product, they licensed it out. So actually, they didn't have any control over the pricing, but the company they licensed it to had been involved in some price fixing. They were ultimately cleared of that, but there was, as a consequence of that, a kind of wholesale change in management. And so you see kind of quite a big share price decline late 22 as a consequence of that. More recently, issues there, I mean, their model, they've got a kind of capital light model, as they describe it. So they own the brand, and then they kind of outsource the manufacturing and the distribution. So they outsource the capital intensive part, and their kind of their key brands in the consumer over the counter part of the business are Kelacote, which is to accelerate scar healing, Nizoral, which is an anti-dandruff shampoo, and Amberen, which is a vitamin supplement for the menopause, helping with the menopause. And they've had, I mean, I think we've seen this in a few companies, this kind of inventory kind of whiplash effect. But in the case of Alliance Pharma, because they outsource the distribution element effectively. They have been historically kind of beholden to their suppliers to have a clear view of what end customer demand is and to order appropriately. And for a lot of companies, we had all this stockpiling effectively during COVID. So companies kind of overorder and then they're destocking, post-COVID. We'll talk about Synthomer, I'm sure, and that's a fantastic example of this. And so they had a bit of there are a few other kind of product specific issues, kind of channel shifts and stuff like that. But effectively, they kind of lost control of the kind of distribution part of their supply chain, and so they've renegotiated with their suppliers. They're taking control, but better control over the online channel, which they had some issues with, and so what we're seeing here is really a turnaround predicated on them having better visibility of demand and that kind of restocking cycle kicking in again.
It seems very cheap, actually. It's only on about 10.5 times PE, and the debt has come down. I think it's below 2 times, isn't it, of EBITDA? So, I mean,
yeah,
you must be quite positive on this. I mean, given there's a lot of M&A in this sector, we've got admittedly on the bigger end, but somebody would potentially snap this up.
Yeah, I mean, historically, I mean, you see from the the share price chart, this was a kind of bit of a darling stock. People like the fact it was not capital intensive, and so they could use the cash flows to buy additional brands, develop and market those brands, etc. So from the current share price, well, they are kind of 65, 70p, something like that. We see pretty decent upside. Sorry, 45p.
45, 46.
Yeah. We see pretty decent upside there to our assessment of fair value. And typically, when we're looking at fair value, we build out a financial model. We build out forecasts kind of typically 3 years ahead because we're looking at these kind of recovery type scenarios, and we look at what a kind of normalized earnings might be over that time horizon and apply an appropriate, usually it's multiple based earnings valuations we're looking at. So we apply an appropriate multiple on a PE or an EV/EBIT basis to those earnings. When we're thinking about valuation, we're looking at the company versus its peer group. We're looking at it versus its own history, so we can kind of get a sense of how the company was regarded in the past, how it's regarded versus its peer group, and to what extent the narrative is likely to shift to allow it to kind of recover that kind of perception in the market.
Yeah, I would definitely think if there was a private equity roll-up strategy somewhere, hoovering up a bunch of sort of like listed small cap OTC healthcare companies, they could certainly knock this one off at less than 8 times EV/EBIT. That's for sure. Because it'd be a no-brainer.
Yeah.
Okay, right. Let's move different sectors. Let's go to the hospitality. We've got Marston, the pub chain. Now, they've just gone through, again, a bit of a deleveraging process. They sold off their joint venture brewing business to Carlsberg, got a whole chunk of cash, paid down a lot of debt, etc., which leaves them purely on as a sort of pub chain. And if I get out in the pub at the moment for a meal and stuff, most of them are actually rammed. Actually, they're still, these gastro pubs seem to be doing pretty well. Anyway, what's your latest for Marston's, because they seem to be on the right track here.
Yeah, absolutely. I mean, Marston's is one that was very much out of favor for a couple of reasons. First of all, level of debt that they had on board, and one thing, a kind of strategy, if you like, that we've made money on a number of times in the past is this kind of deleveraging idea. So the transfer of value from debt holders to equity holders, as a company with excess free cash flows is able to pay down the debt. We could talk about Gulf Marine Services, which is a recent kind of exit of ours, and Marston's kind of fits into that camp. So we had a look at them. We took a position on them kind of April this year. And at that point, the perception is that the company's over leveraged, has got over $1 billion of debt. Again, I mean, look, a lot of this is asset backed. So they obviously have over 1,300 pubs around the country. Also, you know, versus its peer group, there's a perception that, I mean, its background is in the kind of, you know, the traditional boozer, so to speak. And as you pointed out, you know, food is really the kind of key driver in this sector. But they've recently had a new CEO who's come in from Merlin Entertainments, so kind of Alton Towers and, you know, that kind of stuff. So you know, from outside of the sector with a really fresh focus on customer experience. But an interesting feature for us when we looked at in April was this, as you point out, the Carlsberg Marston Brewing Company. So a joint venture that they had entered into with Carlsberg. And it seemed to, you know, at that point, the shares were trading at 26, 27p. And it seemed to us that that JV alone was worth, you know, over 30p a share. So more than the, you know, current share price of the business. And so sure enough, a couple months later, they announced the disposal of their share in that joint venture for, from memory, something like 33 pence.
Yeah.
And so that's enabled a very decent pay down of debt. Management had targeted getting, you know, debt below $1 billion and revenues above $1 billion, and their debt's now somewhere around the kind of 800 million mark, and that really provides them with a bit of firepower to reinvest in their strategy of driving customer experience. They're also reducing their exposure to the smaller wet-led pubs. So they've, you know, they have an ongoing disposal program. They've recently announced a couple of weeks ago disposal of another package of pubs to, I think it was Admiral Inns. So the strategy is playing out nicely in terms of the deleveraging, increasing the mix of food within their portfolio, and driving the top line through that improved customer experience. In terms of valuation, I mean, they had an offer back in 21 for 105p, and that effectively, you know, the tangible book value is a good place to start, I guess. Tangible book value here is probably around 90p per share. So what are the pubs worth, basically, when you knock off the debt held against them? And takeouts in the sector are normally kind of 1.1 times, let's say. So that's about £1. So that, you know, that triangulates nicely against the kind of 105p offer that they rejected back in 21. So I think you get a good sense around that kind of 100 pence of what this company kind of is probably worth as compared to the kind of current share price of around 43p, something like that.
Yeah, I'd have thought with interest rates coming down, the debt bill's going to fall, plus the equity valuation of their pubs are going to increase. So you're going to get a positive jaws happening there. No, I mean, you're right. I mean, the shares trade at sort of 50% of net tangible book, which does seem crazily cheap. There's no doubt about it. Okay, you touched on Gulf Marine Services, that one just a recent sale. They basically do these very large sort of like service platforms for offshore oil and gas, mainly in the Middle East. They've got a bit into renewables, I think, in Europe, etc. What was the sort of the thesis for selling? Is it really just to sort of like take profits on the stock that's done pretty well, deleveraging of late?
Yeah, that's right. Yeah, so we bought into Gulf Marine in 21. At that point, they did have a stretched balance sheet. They had just completed.
So just Adam, you bought it at about what, 3p?
3.2. Yeah.
Okay, so I can understand you are sitting on some good profits here.
Yeah, so they just announced a rights issue, and at that point the largest shareholder sold out their stake. UK-based asset managers sold out their stake to kind of local Emirati investors. So there'd been a turnover in the shareholder register, which is something that we look for, because you have a new shareholder base coming in with a reduced set of expectations. Post the rights issue, although there was still relatively high level of leverage, the thing to remember was that what got them into trouble in the first place was the fact that they had invested in a whole bunch of brand new vessels. And so with a business like this, if they are at a point of being fully invested, then they're going to generate a huge amount of cash, because you've got your depreciation charge against that historic investment, but that's not reflected in the cash flow they've got to pay the capex they need to pay to maintain the vessels. So they kind of did this big historic investment, which means that for a period of time out in the future, and these vessels have a useful life of 25, 30 years, you have significantly reduced capex requirements. And at the same time, oil prices depressed, and you can have a look at what happens when utilization improves, what happens to day rates. If you go back to 2015, their large vessels were on day rates of $100,000 a day, over $100,000 a day. They got down to kind of about $30,000 a day. They're back up to kind of 55 or so now. But we saw a nice path basically to deleveraging and to this transfer of value from debt to equity holders. So we calculate a fair value for the shares over time. As that deleveraging happens, as the day rates and utilization improve, we adjust our fair value. So it's a kind of movable feast. And then our strategy is, we're disciplined about selling out at fair value, basically. So kind of earlier this year, Gulf Marine hit our assessment of approximate value, and so we started the exit process. So we are, it's one we're out of now, and it's I'm sure we usually sell too early. There's usually something left on the table for other investors, but that's our, we stick to our approach, our style, our valuation framework, and that's the decision that we made off the back of that.
Yeah, well, I don't think anybody's going to complain about the 5 or 6 times your money, that's for sure. And you raise a really good point. Discipline buying and discipline selling is really key to be able to sort of like to be nimble and prepared to stick to it. Well, if you've got a successful strategy, that is. So tip your hat. Now, we've got a question from Phil Curtis. Adam, he's just asking about whether you avoid unprofitable businesses, but I probably know the answer to that. But what's your view?
Yeah, so I mean, we have our valuation approach is fairly kind of traditional insofar as we're valuing these companies on a multiple of earnings. Typically, we might do a little bit of DCF, but a company has to be generating profits and cash flow in order to have a fair value on typically a 3-year view in our valuation framework. So we could invest in companies that have maybe lost money last year, maybe you're going to lose money this year, but there needs to be a pretty clear, we have to have a pretty high confidence that they're going to be profitable in the near term. So you can have highly cyclical businesses, for example, where there is a reasonably kind of predictable pattern of companies. Maybe they got high operational leverage as well, and so it might be that they flip into a loss at the bottom of the cycle. But we've got to see that recovery trajectory. So we don't invest in early stage companies maybe that have never made a profit and where the expectation of them making a profit is pushed far out in the future. That's not going to feature in the portfolio. But we can invest in companies which have maybe made a recent loss or a forecast to make a loss this year, as long as we're confident of the recovery trajectory and it presents compelling value on an earnings or cash flow basis in the near term.
I would have thought those companies where you're looking for a recovery, a turnaround, can be those perfect capitulation events, because people who have bought in there maybe for a sort of like a consistent dividend, which is just temporarily cancelled, or alternatively, they see a profit warning and then drop out. Those can be turning points. It's just got to be very selective, haven't you, I guess?
Yeah, you're right. I mean, that type of scenario you talk about is a kind of classic turnover in the shareholder base type scenario. So you have investors who got in for one reason, it doesn't tick that box, and so perhaps even for kind of technical reasons, i.e., it's not paying a dividend anymore, it has to exit their portfolio or their fund. So those can provide great buying opportunities, those kind of technical exits.
Yeah, well, you just got to have a lot of resilience, haven't you? That's the kind of thing, and a lot of faith. I mean, it's easy to talk about it, but doing it when there's real deep blood on the streets takes guts.
Yeah, I mean, building up the right level of conviction is absolutely important, and so that's reflected in the amount of work that myself and my colleague do on these stocks. But equally, I mean, the other important thing is not to fall for commitment bias. So you've kind of you've done all this work on the company, you've grown to like it, you've got it in the portfolio, and you need to be able to change your mind quickly if the facts require you to.
But presumably you do a lot of the homework beforehand, i.e. such that you're watching a shed load of stocks that you're interested in, and if there's a capitulation event that you can hit the ground running if there is a sort of like dislocation.
That's right, yeah. So we've got our portfolio, and then we have an extended watch list of additional stocks where we feel that it may be close but not quite yet the time to take a position. And so these are companies where we've got a live valuation effectively. So whenever there's a piece of news flow, we're updating our valuation, updating our assessment of the risks and the potential catalysts so that we can be very quick to act. And then beyond that, we have an extended list of about 200 companies that we have looked at in the past. We've done these kind of chunky initiation notes on them. We have an old model and we can quickly get up to speed on those companies if they fall into the onto the radar again. So it's not going to take 2 weeks of time. It might take 2 days of time, and we can be up to speed on those pretty quick.
Just to preempt before we get a flood of questions from the audience, don't suppose you could tell us anything what's on that list, can you, Adam? I guess you can't for competition.
No, not really, not onto the watch list.
No, I was only kidding. Okay, well let's move sectors. Let's go to FMCG products, a company that's really been through the mill, PZ Cussons, that does sort of like a lot of sort of personal products. I think it owns
Carex, that's right,
Carex, and also Saint-Tropez, the sort of the tanning business. But anyway, it's got a big business in Nigeria. The devaluation of the naira was about 70%. It had a lot of cash, unfortunately, trapped that suddenly became worthless. They had wheelbarrows of cash out in Nigeria, and therefore, once that was then recut into UK sterling, that unfortunately meant they had a big net debt, which they now need to sort of anyway. Cut a long story short, what's your latest view on this? Because the shares really have tanked of a previous darling, actually.
Yeah, absolutely. Yeah, so as you point out, I mean, historically, it was a kind of West African kind of trading business, trading between Europe and West Africa. But I mean, as you point out, the devaluation of the naira effectively meant they swang from a net cash position to a kind of 100 million odd net debt position, and that was because there was an official rate in the market, but you couldn't actually transact. You couldn't change any money at that official rate, and so the government basically let the rate float, and so as a consequence of that, it had that 70% devaluation, and it's meant that what kind of that they have now been able to get most of their gross cash out of the country, albeit at a significantly kind of reduced valuation. Now, I mean, clearly, sentiment has been significantly hit by that. Actually, in local currency terms, the African business is doing very well. So, margins are doing well, revenues are doing well, and ultimately, with a big devaluation like that, it obviously leads to kind of high inflation in the country. So over time, you get this kind of recovery in dollar or kind of sterling value of the revenues as they kind of hike up because of inflation in the local country. You mentioned Saint-Tropez as well, and actually, the two things they're looking to do at the moment are to sell Saint-Tropez and to sell the African business, and to kind of retrench. I mean, Saint-Tropez is their main exposure to the US market. It's a very, very well regarded brand over there. And so these disposals will see them kind of retrench back to a kind of UK and European focused business, much more focused business. I mean, our view is that sale of these two businesses could be worth. It depends on what kind of view any acquirer is going to have on the value of those kind of Nigerian earnings, but it could be worth anywhere up to 400 million pounds. These two businesses. That's against a market cap of just short of 400 million pounds,
Yeah.
and an EV of about 500 million pounds. So you know, a sensible disposal of these businesses could create a huge amount of value and still leave the company with a load of, you know, great brands, you know, like Carex, Imperial Leather. So I think there's a really exciting opportunity here created by that absolute kind of decimation of sentiment around the stock off the back of that devaluation.
Yeah, no, I mean, I would agree. I think unbundling, if you can realise that value, sort out the balance sheet, then you've got a compelling story there. Got a couple of questions. I'm not sure you can answer these, Adam, but I'll just check anyway. We've got one from Carcosa. He's asking about any thoughts on DLAR, the sort of printing currency company, and then had another one from AJC2 asking about Good Energy. I'm guessing I think that's a sort of challenger energy brand in the UK. I'm guessing you probably can't. You don't know any of those.
Okay, yeah. So I mean, I've never looked at Good Energy. DLAR, we have invested in the past. It's not one that we're on top of particularly at the moment. I know they're looking at the disposal of their security business, I think, to go to a kind of pure play currency printer. But yeah, it's not one we're running a kind of a model on at the moment, so I can't really add a huge amount of value there.
Yeah, all I would say on DLAR, I know they've been sort of like unbundling a lot of their assets there, and I think their biggest shareholder, Crystal Amber, run by Richard Bernstein, I think he's sort of like trying to get that turnaround and to crystallise sort of gains and cash. So I think he's working hard to make sure that
I
it
can imagine.
maximises.
Yes, yeah.
Maximises.
When we did own it, he was the investor at that point, and we always look forward to reading the conference call transcripts because he always had something quite strong to say. Yeah.
Yeah, he sort of like gets his way a lot of the time. So I think that's probably still work in progress. Good. We've got a question from Mike. He's asking about your latest thoughts on Watkin Jones, which again is a bit of a fallen angel. It does sort of like purpose-built student accommodation, plus has gone into sort of build to rent. You'd have thought it'd be doing well in terms of this whole shift in sort of housing, Labour's mandate to increase sort of like, you know, building, etc., to get 300,000 homes per year. But it does a lot of sort of like forward funding with institutions, which I think it's struggled to get the finance for that with a higher interest rate. Anyway, the shares have sold off. What's your sort of, is this one a turnaround, darling, or is this one a value play, Adam?
Yeah, so Watkin Jones is you know, hands up. This is one where we were too early into the stock. So I guess looking at that chart, we would have, you know, bought ours at around the kind of 50p mark or so, maybe just south of 50p. So it's been a difficult investment for us. As you point out, the core thesis is basically, the way to think about Watkin Jones is that it's a cross between a kind of house builder and a contractor. So they own some land bank, so you can look at them in terms of their kind of tangible book value, but they don't have a long land bank like a house builder does, because what they're looking to do, and they talk about having a more of a kind of capital light model insofar as what they're looking to do, is to get, you know, a couple of projects lined up, get the planning permission, sell those projects on to an institutional investor, and then receive kind of cash flows at the signing of the contract when they effectively hand over the plot with the planning, and then get some cash flows at the conclusion of the project when they hand over the finished building. And then there is a recurring revenue stream through their asset management business, so they provide a kind of building management service as well. So if you're thinking about purpose-built student accommodation, you know, you have all the services around running that kind of halls of residence. If you're thinking about the build to rent sector, then you have the kind of concierge service and the kind of all the kind of building management involved in that. So those are the kind of the areas of the business. And you know, Watkin Jones is they were hit. They had the recent profit warning off the back of their customer is the investor, the institutional investor, and those institutions rely on debt for a large part of their financing, and with expectations of interest rate cuts and debt availability kind of slipping out to the right. So some of the contracts that they had been looking to sign, they had not signed in time. Effectively, those had all been had been pushed out, and so that was the core reason behind the profit warning, because the Watkin Jones, the business absorbs cash when kind of early on in the project cycle, and then it releases cash later on. That's the kind of working capital cycle of the business. So although they had a negative outlook, flip side of that was that cash came in ahead of expectations because they hadn't had to put it into the ground to get these kind of projects ready. But the concern there is that that they're going to have to as the market picks up again, they're going to have to get some cash in order to get these projects lined up. And so they're looking at kind of partnerships that they can enter into in order to help support that growth. So our view is that it's not a broken thesis. I mean, that's really what we have to work out at those kind of crunch points. Is the thesis broken, or is this a buying opportunity? And our view is that there's still tailwinds in terms of policy tailwinds, as you pointed out. Labour very keen to drive increased house building, increased residential, and secondly, the interest rate environment is improving, not at the pace perhaps of Watkin Jones would have liked it to increase, but rates are coming down. And you mentioned earlier that kind of 1.7% inflation print, and the prospect that we might have at least one, maybe two rate cuts this year. So all that is a kind of nice tailwind for Watkin Jones. So our view is that the thesis is still intact, but we were too early on that one.
What's the chance of this thing getting sort of like bought out? Because there's quite a bit of M&A in the sector, and it's got a good reputation, particularly in the UK. Done a lot of good sort of like reference jobs. It just needs to sort of like to be taken off the public markets and given a different financial basis to be able to sort of like do what it does well.
Yes. I mean, I think that's a fair point. I've spoken to a few people about this, and I think that what they have that's a nice USP is that full life cycle. So getting the planning, doing the construction, but then also the asset management afterwards. So I think that's potentially quite attractive to a kind of institutional investor.
Yeah. Okay. Well, let's stay in that particular sector, but go to sort of like more sort of like lower cost housing. We've got MJ Gleeson that I think it had a sort of strategy day recently, and is suggesting over the medium term it can triple its profits by almost doubling the number of house completions. It sort of operates in the Northeast and the Midlands in lower cost sort of properties, also does a bit of land development as well. What's your latest on this one? Because it should be a perfect fit for the Labour manifesto to get Britain building of affordable homes.
Yeah, exactly. I mean, as you point out, their focus is very much on lower cost housing, focused on the Midlands and the North, and then they have this interesting land trading business in the South. We bought the shares about 18 months ago. At that point, inflation was a big issue for house builders. Rate tightening was still on the cards. Mortgage availability had fallen off a cliff, so it was an extremely negative environment. And the outlook wasn't particularly good in the market at that point. Earnings were very depressed. I remember kind of a colleague many years ago once said, Adam, if you're buying house builders, buy them when they look expensive on an earnings basis and sell them when they look cheap. And so Watkin Jones, we're definitely looking at very, very depressed kind of short-term earnings there. And so over time, the cycle turns as cycles do, and we've had a shift towards an environment of falling interest rate expectations, and we're not kind of there yet. And mortgage rates have come down a bit from their highs, but there's probably still further to go. But this is, as you point out, there's some nice policy tailwinds in place, interest rate expectations, low cost housing seems like the right place to be. They are of a size where they would be a very easy takeover candidates, both in terms of their potentially complementary exposure, in terms of having a focus on the North and the Midlands, and then also in terms of having this nice kind of land bank asset in the South. So I think it would be a very attractive kind of addition to one of the portfolios of the larger house builders.
Yeah. What's the risk in the budget that if the government decides to remove the land value uplift you get through planning permission and they give that to the local authorities? So when a local authority, their planning department, gives the green light that they can build houses, rather than actually passing all the profit to the owner and to the developer, they basically take a share of that, as a few other countries do, actually.
Yeah. I mean, I think there's a lot of uncertainty for many companies, many areas of the market, many individuals around what the upcoming budget's going to hold. Certainly something like that would affect, probably in particular, the kind of the land trading business. I guess these house builders, there's definitely a contradiction potentially if you're trying to encourage more house building, but then you're also reducing the attractiveness for house builders of doing business. So I don't know how that one resolves, but yeah, it's a risk. Any policy change, policy uncertainty is a risk.
Yeah.
And certainly, I don't know if you planning to talk about Enquest at some point, but that's probably the best example of policy.
Yeah, well, let's go to that now. Yeah, let's go to Enquest. As for investors, is basically an offshore North Sea sort of like oil and gas producer, etc. It's obviously been hit by the government's extended windfall taxes. And in fact, somebody told me the marginal rate now in the UK region of the North Sea is like 78% tax on the profits. Plus, it doesn't give you now it's the Labour government's threatening to reduce all of the capital allowances on it, etc. Which means that there's no real financial incentive to develop any of the sort of like the last oil reserves in the North Sea. So, what's the future on that backdrop for Enquest?
Yeah, I mean, I think if you're looking at North Sea oil and gas producer, then you are looking at the cash flow streams as a kind of short-term annuity. So you're not looking at a kind of 20, 30 years of cash flows coming out of the North Sea. You're trying to work out what kind of value you can see on these companies on a sub 10-year basis. And Enquest stacks up very well on that basis. They've got a focus on the UK North Sea. They also have some assets in Malaysia. The UK has been has had an incredibly unstable tax regime. Some of the oil majors have said it's more predictable operating in a war zone than operating in the UK North Sea. The standard rate of tax in the North Sea has been 40%, and then there's the EPL, the additional levy of 38%. So that gives you a 78% tax rate. Enquest historically has made some big investments in the North Sea. One in particular, the Kraken project, which is now one of the kind of larger.
That's heavy oil, isn't it? That's heavy
oil. That's right.
Yeah,
it's heavy oil. Yeah, that's right. And they built a FPSA specially for the project. And as a consequence of that, they have some pretty chunky kind of historic tax losses. Now, the historic tax losses you cannot apply against this 38% additional levy, but you can apply it against the 40% standard tax rate in the North Sea. And they've got, they've on the balance sheet, officially they've got about 2 billion of losses. They've got recently took an asset off, I think it was BP, which came with another billion. So they have ultimately in the next couple of years, they're going to have about 3 billion of tax losses there. So in sterling terms, think about in sterling terms, that's like 2.3 billion pounds that they can apply against the 40% rate. So that provides them about £1 billion of tax cover effectively on future profits. So that £1 billion of tax cover, you can compare it against a market cap of like 200 million.
Yeah.
Or an EV of 450. I mean, Enquest has produced a lot of cash in recent years, and it's brought its debt down significantly from, I think it was $1.6 billion at peak, down to a few $100 million now through kind of cash flows that it's generated. It's also been able to pick up, as majors have left the North Sea, it's been able to pick up assets effectively for nothing. It's been kind of handed assets by kind of departing oil majors.
Does it have any decommissioning exposure here at all?
Yeah, so there are decommissioning liabilities as well to take account of, and they are they are also picking up decommissioning. There is an opportunity to potentially pick up decommissioning business from other people because they are doing a lot of work in that area in the North Sea. So they're generating a lot of cash flows they've used to pay down the debt. They're doing around $100 million free cash flow equity a year. So that's the rate at which they can reduce that debt organically. And they just started doing share buybacks as well with those cash flows. They've done some modest share buybacks recently. They could ramp those up significantly. I mean, they could retire the current share price. They could retire 25-30% of their share capital in a year without blinking, really, without breaking sweat. So in terms of a current cash flow basis, the company is incredibly cheap, as all UK North Sea focused operators are. And then they have the additional kicker of this vast tax umbrella worth many multiples of the current kind of market cap of the business. I mean, it definitely ticks the box in terms of capitulation event, negative sentiment, all that kind of thing. Objectively, the valuation is absolutely compelling. There's always policy risk. Who knows what Ed Miliband might do next? But these are the types of situations where I think that there is the valuation and the kind of objective value that we can calculate of this business, and then there's the sentiment in the market, and there's just a huge difference between the two.
If you can what's the lifting cost for the oil per barrel on these?
Yeah,
the danger is that the Saudi decides to open the spittles, and its lifting cost is about $5 per barrel.
Yeah, that's a fair point. Yeah, so it's between $21 and $23 is their OPEX per barrel. So it is. I mean, it's significantly higher than Saudi. UK North Sea is not a kind of a low cost basin, but there is a decent margin between Brent and their OPEX per barrel.
Yeah, okay. Got a question from Phil Curtis. He says on this, not on this one, but it applies. Adam, how do you avoid falling knives? Given this one's come from 150p, sort of like about 10 years ago, I guess. It's sort of like perpetually been cutting people.
Yeah. I mean, that's a very good question, and we don't because of the nature of the situations we're looking at, we certainly don't always get it right. What we try and do is to understand what entry point would give us an attractive risk return payoff. So it's not to say we're going to catch this on the bottom tick before the recovery, but at least if we understand fully what the risks are, if we have a good view of what we think the valuation should be, then we can be prepared to stomach some pain on the journey to get there, as long as there's nothing that breaks our thesis along the way. So I think it's not a question of trying to catch it at the bottom. It's a question of understanding that you will often be early, but that you understand the risk factors and what the potential upside is, and that gives you the conviction to kind of to carry on holding it through any potentially difficult times. We do look at some things like turnover in the shareholder base, and so you touched on before about some stocks that might stop paying a dividend, and some investors have to leave the register, and so those point, and I spoke about Gulf Marine. So those moments of high churn in the shareholder base can also indicate that there has been, that you're approaching or at a bottom on the basis of those, departing. You've basically got a new shareholder base that has recently entered and is not likely to be looking to exit that position in the very near future because they bought into it on a completely different basis to what the previous shareholder base had bought into it at. So that can potentially also give you a bit more confidence that you're kind of through the worst of it, certainly in terms of on a kind of sentiment basis, and that the existing shareholders have much lower, much more realistic expectations.
Yeah, and also it's just part of the strategy. If you're operating at the capitulation phase of a lot of companies where there's greatest fear and great not surprisingly volatility and potential greatest risk, then some of them are going to go wrong. But as long as you don't actually increase your position in falling knives, basically don't double down, then the ones which, like your Gulf Marines, which 5 times your money, more than compensate for the ones which do go wrong. So overall, as a portfolio strategy, you generate a lot of alpha because the direction of travel is up. You just got to accept that you're going to be wrong occasionally.
Yeah, and that's kind of what you're getting paid for, taking that pain.
Yeah, and that a lot of individuals can't hack the the pain of being badly wrong. I agree.
Difficult for individuals. Actually, more difficult if you're a professional investor, because you're not just having to look yourself in the mirror, you're also having to answer to your investors and potentially to the CIO, and there's career risk and all these kind of things going on. So I think that explains why this strategy doesn't really exist anywhere else in the kind of institutional world, because it is just unbelievably that the kind of investment industry is not really set up for this kind of strategy.
Yeah, I mean, idiosyncratic risk is a difficult one, isn't it, for professionals? They like to sort of hug benchmarks. Okay, we've got a question coming in from Mike. Follow up on Watkin Jones. Is there any possibility of a placing coming there? And I'm guessing they must have inferred that they're looking at financing arrangements.
Yeah, that's right. Yeah, absolutely. So the last update that they did was, say, ambiguously worded. I mean, management did, subsequently kind of point out that the purpose of their so the kind of end of the statement was just about kind of needing additional sources of cash to capture the turnaround in the market when it came, and they subsequently clarified that they are looking at partnership arrangements, but the wording left it open to a placing, and management haven't explicitly denied, categorically said that there will be no form of equity raise. So I think that is really the reason why the shares fell so hard and on the day is that was that final paragraph in the update, really. So it's not the I think it's not the most likely course, but it is a possibility. I think that the fact they're trading at kind of half book value, and because of the various tailwinds that we've spoken about, I think if they did need to raise some money, I don't think it would be that challenging. I think most investors can see that this is exactly the point in the cycle when you would want to back a business like this.
Yeah. Net tangible assets, I was doing it. It's about 46p. So the shares are about 27, 28. Yeah, you're right. Significant discount. Got another one on apparently from Mike. He's basically asking about FUTR Group, which I don't know if you own it, but they've had must have had a bit of a profit warning this morning. Shares are down 15%.
Yeah, it's not a profit warning, a management change. So they had so John Steinbeck, US CEO, joined I want to say last year. It could even have been earlier this year, with his gas strategy, growth acceleration strategy. The business had been built through acquisition effectively, and wheels had come off, and the new CEO was brought in to kind of tidy things up. They had decent. So we picked these up. Would have been about £6 probably earlier this year. And at the point at which expectations were still falling, and then they kind of came out with a kind of inline statement, and which was read very positively by the market. So they recovered nicely up to kind of 11 quid or so. They've drifted a bit, and then today the announcement is that the CEO is handing his notice. Basically, he wants to return to the US for kind of family reasons. But I think this is because he's only been around for a relatively short amount of time, and the market's really been backing his strategy, and it's appeared to be working. That's been taken quite negatively today.
Yeah, there's a lot of I mean, 15% key man risk is quite a big pill to swallow, I would have thought. But yeah. I mean, anyway, let's wait and see on that one. Okay, let's move to another one in the sort of the construction area. We've got Costain, which is a sort of like archetypal sort of contractor, got a huge order book, £4.3 billion currently, servicing the I think it's got a big water exposure, which is going absolute gangbuster AMP8, because all those unfortunate water companies are pouring sewage into the sea, into reservoirs. Equally, you've got sort of like infrastructure being labelled by the Labour government as a growth area, building roads, rail, etc. But you also have had a Rachel Reeves about a month ago, I think, did actually say she was cancelling a few of them. What's your sort of your overall take on sort of like, the civils contractor Costains?
Yeah, I mean, I think this is a sector where, on average, the average business in this sector is of a significantly better quality, a significantly reduced financial risk to what they had, say, kind of 5-6 years ago. So you go back to Carillion, Interserve, these companies going bust on the basis of the fact that at that point the industry was getting big fixed price contracts, big cash lump sums up front, paying their contractors very late. And that has all changed significantly. And so, back in beginning of 20, Costain did a rights issue, sorted out its balance sheet. It no longer takes fixed price contracts. Government produces the quarterly or semi-annually updates on payment speed of large contractors. Costain is always in the top 3. So these companies have become kind of much more responsible than they were historically. And in the case of Costain, there's a nice margin expansion story here as they introduce more consulting into the mix. The company is extremely cash generative, and so they have a nice buyback program going on, which has been helpful to the share price. There are a number of companies in the portfolio which are doing buybacks. I mentioned Enquest, Eurocell is another one doing buybacks. So I think these, the sector, Costain in particular, are undervalued, as there is this kind of still some negative sentiment around the kind of the late period just prior to COVID, when the sector was effectively seen as uninvestable.
Well, what's the sort of USP? Because the margins are so slim, aren't they? This whole sector is sort of 3 or 4%. I mean, what's that pricing power in USP?
Yeah. So it is very, very tight margins. But there is a reasonable kind of margin expansion program underway off the back of this kind of changing mix. So things like the technology involved in smart motorways, more kind of complexity requiring a higher level of kind of upfront consulting and advisory. So that creates the opportunity to drive kind of margin improvement, and also to get on board in the projects in the kind of earlier stage of the life cycle.
Okay, good.
So
I've got another question.
Looking at a kind of 5% kind of margin kind of profile, basically.
I think good luck with that.
Yes.
Because I don't think the sector's ever done 5%.
Yeah.
Well, it may have done. I don't know. We'll wait and see. Okay, got another question from Phil. He's asking about any areas that you in the UK market that you're avoiding at the moment, sort of sectors. I mean, one which has been totally mullered of late is the staffers, is the recruitment, because they're all coming out with horrible numbers, which is sort of quite surprising actually, because unemployment seller. But any sectors that you're avoiding, Adam?
So there's no sector. I mean, I think starts really interesting point on the staffers. I think you look at the share price charts, a lot of these companies, and that for us that is, in terms of screening for new ideas, that's one starting point. Which sectors, which companies, I should say, have had a really horrid time over over the last 3 years, and what can we kind of pick apart from that as to what the underlying causes have been. So recruiters potentially an interesting area to start having a think about purely on that basis. I would say there's no sectors that we kind of don't look at in principle. There's nothing that we would just put a kind of blanket over. I mean, there's always complexity. There are some companies, some sectors which are much harder to look at and to understand, kind of specialist sectors. And so there it's a question of trying to decide whether there is a big enough opportunity set within that sector that it's worth putting the effort in to try and pull apart, a specialist sector. So things like financials, insurance, these are areas that you need kind of specialist knowledge. We have invested in financials in the past, but it does require a lot more work. So I think that's our kind of key consideration, the understandability basically of the business model, more so than saying we're just not going to look at that sector out of principle.
Yeah, no, banks and the insurers and the financial guys are just black boxes a lot of the time, particularly the really big ones are really tough. On the staffers and recruiters, it's a lot of them are talking about sort of 15% decrease in NFI, the net fee income they earn from putting in temporary and permanent. But I think a lot of that actually is just a reflection of the actual corporates, because even though the unemployment rates around the world are at pretty much historical lows, that most of the corporates at the moment aren't recruiting, they're not hiring, but equally they're not laying people off. And the reason for that is, I think, is that they're not sure about the economic certainty, but also they're looking at deploying AI where they can take people out at a later date. So I think it's work in progress actually for the staffers at the moment.
Interesting. Yeah, that's a good point.
Okay, good. Well, let's move to another one in the building products. Really done very well for you. Eurocell, you touched on it earlier on, does PVC doors and windows, but I think a third of the actual products are actually done from recycling PVC, which is a sort of unique one. And they're on a sort of like a mission to increase their profit margins.
That's right, yeah. So they are the UK's biggest recycler of PVC windows. Their core business is making the profiles for the PVC profiles for double glazed windows and doors. So they don't fabricate the windows and doors themselves, but they make the profiles that then go to the fabricators. They also make fascias, barge boards, plastic components that go on roofs and that type of thing. So if it's kind of building product and it's needs PVC, then they're probably involved in it. Eurocell's they kind of went through a period where they were quite capital intensive, so they kind of invested in their production line, invested in their distribution center, and were putting a lot of money into opening new branches. So their customers are either the fabricators of the windows, or they also have a kind of merchanting business where they'll sell plastic roofing components directly to builders. So they had gone through a very capital intensive period. Now that their production line and distribution center is fully invested, and they've taken a more kind of balanced view to the expansion of their outlets, they are enjoying they have the opportunity for less capital intensive top line growth. The market is not great at the moment. So their most recent updates saw top line decline, but pretty strong margin expansion. But as we see the top line grow, we'd expect that margin expansion to accelerate. They're also generating a lot of cash now. They've got this less capital intensive approach. So and that is feeding buybacks. So the latest update, they announced they're extending their buyback program from 10 million to 15 million sterling. So that's been a nice kind of kicker to the share price. So I think it's in a good place if we are believing the thesis of improved new build markets, off improved mortgage availability, and then this is the kind of second line that's going to benefit. I mean, a lot of what they do is, I mean, they do have some sales into the new build market. A lot of what they do is RMI.
Yeah.
And so that repair and maintenance market typically lags new build market by kind of 6 to 9 months. So we have this, Eurocell presents an opportunity further down the down the food chain as the new build market kind of picks up.
I think there must be an investor perception problem on this one, because they do gross margins of 52, 53%, which says to me in a sort of like, you'd think, and I say perception and misperception in terms of, thinking this type of market, PVC doors and windows, gross margins would be low, but they must have pricing power to get 50,
yeah,
52,
I mean,
53%.
they are. It's been a sector where they've picked up market share very nicely off the bat. I mean, you think about that, their customer base are the fabricators, the companies that are selling to consumer. And you had during kind of off the back of COVID, you had some companies kind of getting into trouble. So SafeStyle, listed business, got into trouble, went bust. SafeStyle was not a customer of theirs, and so as their that meant that their customers picked up more market share, which in turn is additional market share for them. And they also, through the merchanting business, have a nice kind of USP for their customers, so they can support their taking their customer base as a fabricators, they can sell their customers product through their merchanting sites, which in turn generates additional market share for them. So they've got a nice kind of position within the supply chain.
Good. Okay, let's move to waste. We've got Renewi, which is basically a recycling business now in Europe. I think it's got big positions in Benelux and Holland. It just recently sold its landfill business to Shanks. I think it had a joint venture with them or something in the UK. So it's now fully recycling in Europe. What's your sort of your latest view on this one? We've also got another question relating, or simply, it's basically from Terry Vaughan. He's asking about when you buy overseas companies, and this one is a UK listed, but it's also overseas. It says, when you're buying overseas, how do you manage the currency risk? So really, a couple of two-prong question: update on Renewi, but also the currency management.
Yeah, so Renewi is, as you said, they've recently exited their UK local authority business, which is part of the old Shanks business, and so their focus now is on recycling effectively. They have had some issues with their Dutch soil taking kind of soil from brownfield sites basically and kind of cleaning it up and then reselling it for use on sites. So that's been part of the kind of turnaround story there at Renewi. Really, the opportunity for them is that they have, if you're a waste disposal company, then you get paid by your customers to collect the waste, and you in turn have to pay for the disposal of that waste. But if you are a recycling company, then you can extract value from that waste and actually sell it on. So so a nice example would be plastic recycling, for example, where all companies have to have a certain percentage of recycled plastic in their finished product, otherwise they have to pay a fine. And so the value of recycled plastic has increased significantly off the back of this legislative driver. So there's that opportunity kind of across the piece. So one of their KPIs is the proportion of the waste they collect that ends up getting recycled instead of going to landfill or getting burned. And so that's a it's a margin driver for them, and it also fits nicely into a bigger kind of sentiment-driven theme around ESG and environmental issues. So I think this is a type of stock which should really be a kind of ESG kind of darling type stock in terms of it being kind of right there in the heart of doing something to improve the environment, as well as having a nice kind of margin expansion strategy off the back of that.
One of the private equity guys put a number on these, didn't they, a few years ago, if I remember rightly? It's basically infrastructure play, because I think that you had O'Gean, which just has waste in the UK, getting bought by a couple of infrastructure
you're
plays.
absolutely right. Yes, that's right. Yes, there were a couple of years ago. I think there was O'Gean. I think there was another company in the sector. I think that got taken out. I think in the same year there were 2 takeovers within this waste management sector. So it has been very much in the spotlight there. Yeah.
Yeah. Okay, good. Let's move to one you mentioned earlier, which was a Synthomer, which basically is a chemicals business, coatings and adhesives, but also does, unfortunately, medical plastic, PVC gloves, latex gloves, etc., which did brilliantly in the, as you say, in the lockdown. But anyway, it's built up a lot of debt, which is trying to deleverage. This must be right, sort of sink straight into that sort of like center of the deleveraging story that you like, because you can generate a lot of transfer of value from the debt owners to the equity if they get it right.
Yeah, I think there's a couple of themes here. I mean, the other theme is this kind of inventory whiplash effect, and Synthomer is the best example of that. We saw a lot of this coming out of COVID as companies stockpiled during COVID and then had to work down those inventories post-COVID. And in the case of Synthomer, the reason it's probably the best example of this is that one of their core products is NBR. It's effectively the main ingredient that goes into medical rubber gloves. And so if anything got stockpiled during COVID, it would have been those medical supplies. So we saw a kind of nice kind of rally towards the end of COVID off the back of stocking, and then we've had this precipitous decline off the back of destocking, that kind of whiplash effect. And so there's a couple of elements to this business, but I think really the key turnaround piece and the key sentiment piece is around this rubber glove sector. And I think the recent news we've seen, there's a company called Top Glove, for example, who is probably the world's biggest manufacturer of these gloves, so a key customer of Synthomer's, and they've saw recent results. I think volumes are up something like 20% year to date. So I think the key message there is that we are through the trough. The destocking period has come to an end, and we're back into a more normal environment in terms of the end customer demand linking up with the sales more closely. So I think that's the kind of the opportunity here, and it's fascinating to see these situations where you get them. We've got investment in Wynnstay, for example, we could talk about, but you get these situations where you have these short-term kind of effects that they get amplified for various reasons. In the case of an inventory cycle, it's because the customer demand changes by 5%, so the retailer demand changes by 10%, and so the wholesaler demand changes by 20%, and they kind of pass this amplified, a bit like on the motorway, and the person at the front maybe just flashes the brakes a bit, and then there's like a massive tailback 5 miles down the road. That's kind of what you've seen with these kind of inventory effects. But and in the market, effectively that comes in the form of analysts and fund managers extrapolating whatever the most recent quarter has been at into the future, and thinking that this is the beginning of a new super cycle, or on the other end, the world's going to end, and so that creates the opportunity. So I think that's what we kind of seen with Synthomer. We've seen it both ways. We've seen this view that medical rubber glove is going to take over the world, and then this view that nobody will ever need them again, and the truth lies somewhere in the middle, and that's the opportunity with Synthomer and these other kind of similar companies where you've had this inventory effect, or very, other companies where you have kind of large swings in short-term demand getting extrapolated.
How do you sort of get comfortable with a company with a high debt to debt level in terms of, I think Synthomer's got, is it 4.7? I can see in the latest net debt to EBITDA multiple. It's got a big 300. It's got a big, I think, next major bond maturity in 2027. How do you get comfortable that it can pay the interest and it's not going to breach its banking covenants, particularly given it's unprofitable in the short term? It can get through it to then generate that, to give it time to be able to become sort of like, profitable, to be able to get the covenants in the right place.
Yeah, so we do a lot of work on our cash flow forecasts, and for us, when we're thinking about debt, it's not purely a case of kind of headline leverage multiples, but also digging behind that to understand the working capital position of the business and what will happen to working capital in terms of releasing or absorbing cash under different scenarios. So, top line growth, top line decline. How does that play out in terms of working capital and therefore cash flow and therefore the impact on net debt? So we get comfort through modeling those things out, and playing it through different scenarios.
Okay, good. Okay, well, let's move to the one you mentioned, Wynnstay, which is basically an animal feeds business in the UK. Also does fertilizer, I think. Must be dependent, I guess, on sort of like livestock prices and dairy, and also input prices on fertilizer and stuff like that. How much income the farmers have actually got, how wealthy they feel.
Yeah.
But they came out with a bit of a profit warning, I think, a few weeks ago.
Yeah, that's right. Yeah, and the weather, of course, is a big kind of driver for these guys. So Wynnstay is a company which it's a kind of classic small cap in that it's not, there's one analyst covering the stock, so there's not a huge amount of coverage out there on it. And in those type of situations, we feel we can really add value by having our own financial model, our own earnings forecasts on a stock. If it's a mega cap, there's not really anything we can add beyond what the 30 other analysts covering it are adding are saying. But with a company like Wynnstay, we feel that we can. I think that the thing that brought Wynnstay onto our radar really is a kind of it is a kind of classic Ben Graham net type opportunity. So one of these kind of old school value approaches, a kind of Ben Graham net is a kind of valuation approach where you take the current assets of the business, so anything that can be converted into cash in the next 12 months. In other words, the inventory, the receivables, and the cash. So it's like and then from that you deduct all of the liabilities of the business, so all of the debts, all the accounts payable. And you end up with like a hardcore liquidation value for the business, what it could be worth under a kind of worst correct case fire sale scenario where you just write off all of the buildings, all the fixed assets, say they're worth nothing, just take the cash from your short-term cash and receivables, pay off all your debt, what's left for the equity holders. And the number for Wynnstay is something around 330 pence. As opposed to a current share price, I think you got on the screen of kind of £3.15. So that's that's what attracted us to Wynnstay, is that effectively if you buy them cheaply enough, then you have a decent, as Ben Graham would say, a decent margin of safety. You've got that kind of sure, it can still be volatile in the short term, you can still lose money in the long term, but ultimately you have that kind of that reassurance. And Wynnstay's one we know reasonably well, having owned them in the past. So they were a kind of nice trading opportunity for us a few years ago around kind of first half, second half weightings. And so in that situation, the first half numbers had come in. They were punching them into our model well ahead of where they needed to be to meet the second half. But there was no change in the kind of broker numbers. So the share price response was quite muted. But to our mind, there was basically an upgrade absolutely baked in the second half. And so that was opportunity to get in, take the the kind of a couple of upgrades into the year end, and then sell out. But here we just feel there's a core value there that's not being reflected in the share price.
Yeah. But I mean, other than sort of like the the cigar butt type investing, which is the Ben Graham type of thing, what is the USP again on this one? Because it's ultra slim margins, supplying commodity animal feed basically.
Yeah, so
Fertilizer.
there's kind of two elements of the business. There's like what they call the bulks business. So that's that's feeds, fertilizers, and grains. And then there's also a merchanting business. So where they've got kind of outlets selling to farmers and also to smallholders, or even just people who live in the countryside and want to build a fence, or have a pet farm, or keep some chickens, or whatever it might be. So there's two elements of the business. The merching business is much higher margin than the grain business. In the bulks business, they sell they sell with a kind of fixed margin by weight, so to speak. So rather than take a kind of a margin on the revenues, it's a kind of margin on the weight. It is it's a key part of the rural supply chain. So although it is a very low margin business, it does have a kind of critical position within that supply chain. They blend their own fertilizers, and this is going to be increasingly important. I mean, the fertilizer market in the UK, there is it's a kind of integrated global market insofar as you can blend it in the UK or you can import it from abroad, and it all depends on energy costs, all these kind of relative energy costs in the UK and abroad, et cetera, et cetera. The dynamic of the market is changing insofar as there is increasing requirements for fertilizers used on farms to be customized and tailored towards the soil requirements of that farm. So rather than just kind of spraying nitrates everywhere in huge amounts and seeing what sticks, it's about performing a kind of assessment of the requirements of that particular field, that particular farm, and that plays into the hands of domestic suppliers who have a network and infrastructure relationship with the farmers, that they can go farm by farm, produce customized fertilizer mixes to kind of meet farmers' requirements, meet legislative requirements, improve their margin, and reduce the impact of kind of lower cost imports when that kind of, as and when it's kind of supply and demand, the pricing is appropriate for those lower cost imports. So so that's the kind of the kind of changing market dynamic there, which I think plays into their hands.
Okay, good. Okay, well, we're coming towards the end. Just a comment from Nigel Batty Seams, Adam. He says he loves your artwork in the background.
Thanks, Nigel.
Okay, we've got final two, both in the same sector. We've got TT Electronics and XP Power. TT Electronics, basically, as it says on the tin, makes electrical products which goes into the electronics industry. And I think XP Power, slightly higher margins. It goes sort of like discrete sort of transformer projects which go into the semiconductor industry, medical industry. But they've both been through sort of profit resets of late and profit warnings. Let's start with just quickly on TT Electronics.
Yeah, so TT kind of most recently they've had some operational issues in their high margin North America business, which has hit the share price. That is against the kind of backdrop of a relatively new CEO. So Peter France has joined in the last 12 months. His last CEO role was at Rotork. He did 9 years at Rotork, did a pretty decent job there. That is obviously a much larger, well-regarded business. And taking the lessons that he learned there, he's got a program of cost savings and inventory management at TT Group. But the short-term kind of challenge for them is rectifying the operational issues in this particular kind of North American division. But I think they've got some great end markets: industrial, aerospace and defense, and healthcare. and I think that their Project Dynamo under the relatively new CEO's leadership should deliver some really nice margin expansion back up to the levels that you would expect across the peer group. So they're kind of under earning relative to the peer group.
Yeah, they only do sort of 7% EBIT margins. And what about XP Power? Because that one had a lot of destocking issues, I think, about a year ago, and then it had a predatory bid that it rejected.
Yeah, that's right. Yeah. So again, this kind of COVID, post-COVID kind of destocking cycle, very, very much in evidence at XP Power. Their power supply units go into many healthcare industrial applications. In healthcare, they can go into products that are heavily regulated, where the power supply unit is a kind of critical component that gets signed off and specified into the end product for the duration of the kind of product lifestyle cycle. So you sell into a product, and then you've locked in your kind of customer for the next 5-7 years, whatever it might be. They were a kind of quality growth darling pre-COVID, and that's reflected in the shareholder base, and also reflected in the fact that after COVID, when they had the destocking issues, they had to do a rights issue. The rights issue was at 11% premium, which is obviously quite unusual, reflects the kind of the solid shareholder base that they had. We bought them kind of March this year, which was kind of fortunate timing, because a couple months later they had the bids, and the final one was for 1950. Which they rejected. Our view was 1950 was very generous. Our fair value was actually below 1950, so I think the shares got up to 17 quid, something like that, maybe a touch more. So we actually sold most of ours at that time. More recently, we've kind of topped up a few, because it's drifted back down to the territory where we can see some reasonable upside from here.
Yeah, well done. I mean, that again, it reflects the disciplined selling approach, doesn't it? It's sort of like what sticking to the knitting, essentially.
Yeah, absolutely. Yeah, because it's so easy when share price has done really well. You feel like a genius. It's nice to have in the portfolio because you can talk about it. But those are probably the times when you need to be on guard against your own behavioral biases.
Yeah, okay. Got one final question from Phil. He's asking about the asset management industry, another one which has really been a pariah, I think, across the UK sector. We've had a whole bunch of them really being hated, and they've gone from darlings to really distressed assets. What's your thoughts on the asset management interest? And also, have you had a look at Liontrust at all? Because I think that one's had a couple of rock star fund managers leaving, I think, about a year ago or so.
Yes, I mean, it is a sector we've looked at and have invested in the past without a huge amount of success, to be honest. So I mean, there are some structural headwinds here. Really, it's very well documented. The rise of passive and pressure on fees, squeezing the kind of bulge bracket. I mean, my kind of personal view is that we see increasingly this kind of barbell within the industry. So a lot of money going into, as it has for the last decade, into low cost passive, which only gets cheaper and cheaper. It's almost costs you almost nothing to pick up beta exposure to the UK equity or developed equity market. And at the other end of the kind of barbell, I think there is appetite for genuinely differentiated kind of alpha opportunities, differentiated strategies, and the stuff that gets squeezed is the kind of the high capacity kind of Me Too stuff in the middle, the kind of arguably the closet tracker type stuff. And the challenge, if you're running an asset management business, is that your profitability is kind of tied to AUM, which in turn leads you towards products with high capacity, which in turn pushes you into that kind of middle ground, to try and building something that's going to suit all people, effectively. And that's not really, I think, what's working in the market. So I think, if you've got a super low cost passive strategy, then that you're probably in the right place. If you have a kind of niche highly active strategy, you're probably in the right place. But if you've got a strategy that's trying to be all things to all men, then you're probably going to struggle. And so that's the kind of philosophical challenge, I think, for the kind of the most of the asset management kind of industry generally. So we have held Jupiter actually in the past, and I think Liontrust, I haven't looked at them recently, but I know they have been paying a very nice dividend, a good yield on Liontrust. And I don't know whether they're still paying that, but it's not a sector we're involved in at the moment.
Yeah, I mean, my take actually on the passives, yes, it's been an acceptable rise, no doubt about it. But at some point, you will have a moment of truth, because if it's essentially it just follows what the price action is on the previous day, which is buy high, sell low, sort of stuff. Then at some point, that's going to have a moment of truth, isn't it? A reality check.
Yeah, I mean, I think passive is essentially a momentum following strategy, because you are over-indexing on the stuff that's gotten bigger and selling down the stuff that's gotten smaller. So it's a way of playing that. Not that often when people buy it, they're aware of what the style bias is of what they're buying, but and then you need some form of active in order to do the price setting to allow passive to to occur. So there has to be some kind of balance for the industry to work effectively.
Well, you just if you're not careful, you're going to get huge price dislocations to intrinsic worth, and they're going to have to reset at some point. I mean, I did hear an amazing stat. I think it was yesterday. They were talking about the overall gains on the S&P 500 this year, and I think they're about 25% year to date, something of which 20% of the 25%. So effectively 80% of all the S&P 500 gains has come from one stock, Nvidia. Nvidia this year. I mean, that is just frightening. I mean, that stock is brought forward so much demand into periods for its, sort of like all its GPUs. I mean, that's gonna at some point in time that is gonna reset. But hey, at the moment, because everybody's jumping into it, it's enormous. It really is.
Yeah.
Anyway, I prefer your very much deep value contrarian style. Thanks, there, Adam. So and I think the audience have as well. So thanks again, Adam. Really, really helpful. Excellent insights and updates, and very, very honest opinions. So thanks again, guys. Thanks again,
Adam.
Paul.
Thanks for having me.